I have spent the better part of 40 years watching money move. Not the flashy money, the day traders, the crypto speculators. I mean real capital, the kind that builds nations, sustains pension funds for decades, and determines whether a family finishes their journey in dignity or desperation. When you look at the global economy as a demographic map of human lives, you start to see patterns, and right now the pattern I see is alarming. It is not a crash, it is not a sudden drop that makes the news. It is quieter. It is a slow-motion collision between biology and mathematics. If you are in your 50s or 60s right now, you are standing at the epicenter of this collision. You are part of a generation handed a financial experiment showing cracks in its foundation. I want to speak to you directly today as an observer of history, because if you do not understand the water you are swimming in, you cannot hope to stay afloat. We need to have a serious conversation about longevity, about the changing nature of retirement, and about the brutal arithmetic of the next 20 years. Most people believe that if they just save a little more, they will be fine. I am here to tell you that the old rules of saving are dead. The economic environment we are entering is unlike anything we saw in the 80s or 90s. And if you are approaching retirement age, the margin for error has effectively vanished. To understand where you stand, you have to understand the ground beneath your feet. I have watched the architecture of retirement change completely within a single lifetime. If we go back 40 years, retirement was a three-legged stool. Personal savings, government social security, and crucially, a defined benefit pension. That pension was the anchor. It was the company's responsibility. A professional committee managed that money. They bore the risk. If the market crashed, the company had to make the pension whole. You simply had to show up, do your job, and retire. The check would come every month until you died. That world is gone. We shifted from defined benefit to defined contribution. We moved to the 401k. On the surface, this looked like freedom, but what it really was a transfer of risk. We took complex actuarial math and investment management, jobs requiring teams of experts, and handed it to the individual worker. We said, here's an account. Good luck. Hope you pick the right funds. Hope you don't sell at the bottom. I have analyzed the data from this 40-year experiment. The results are sobering. The average investor performs poorly not because they are unintelligent, but because they are human. They buy when they feel confident at the top and sell when they feel fear at the bottom. But if you are 55 or 60 today, you don't have time to lament the loss of pensions. You have to deal with the reality of the 401k world. And the reality is this: you are now your own chief investment officer, your own risk manager, your own actuary. Most people in their 50s are not losing sleep over beating the market. They are losing sleep over a simpler, more terrifying question. Will the money run out before I do? This fear is rational. Here is the variable that changes everything. You are going to live longer than you think. In my early years, we planned for retirement lasting 10, maybe 15 years, retired at 65, and the portfolio only needed to sustain you until your late 70s. Today, I am seeing client profiles where retirement is a 30-year distinct phase of life. If you retire at 65, there is very high probability that you or your spouse will see 90. Think about the math. If you work from 25 to 65, you are working for 40 years. That capital then has to support 30 years of unemployment. You are trying to fund 30 years of consumption with 40 years of production. The ratio has shifted dramatically. This is the longevity paradox. Living longer is a biological triumph, but it is a financial catastrophe if you are unprepared. I have sat across from people who reached 85, looking healthy and vibrant, but their eyes were filled with terror because they had 5 years of money left and 10 years of life. That is the situation we must avoid. When I look at markets today, I see people obsessed with the wrong risks. They worry about the market dropping 10% next month. That is volatility. That is noise. The real risk is the permanent destruction of purchasing power over a 3-decade retirement. If you are 60, you have to stop thinking about preserving capital in nominal terms. You have to think about preserving purchasing power because a dollar today will not buy you the same healthcare or food in 20 years. I have seen inflation destroy more retirements than stock crashes ever have. A crash is loud. It happens fast. Inflation is silent. It is like carbon monoxide. You don't know it's killing your portfolio until you wake up 20 years later and realize you can only afford half the life you used to lead. Let me discuss the psychological trap I see when people hit their 50s. I call it the hope strategy. This happens when a household realizes they are behind. They don't have enough saved. So what do? They take on more risk. A 55-year-old realizes they are short, so they move money into high-growth speculative assets. They try to catch up by swinging for the fences. They buy hot tech stocks or crypto. They are trying to compress 40 years of compounding into 5 years of speculation. Let me be clear. The market does not care about your timeline. The market does not care that you need to retire in 5 years. When you take excessive risk in your 50s, you are not investing. You are gambling with your survival. If you take a 50% loss at 30, it is a scar. You heal. You have income. You have time. If you take a 50% loss at 60, just before you stop working, that is a mortal wound. You do not have the years of future work to earn that back. I need you to embrace a different mindset, the mindset of the steward. A steward does not gamble. A steward protects and grows slowly. A steward understands the goal is not to get rich quick, but to never get poor. This requires a difficult pivot. For your entire life, you use labor to generate money. You worked, you got paid. Now you are transitioning to a phase where your capital must generate the money. Your money has to go to work every day, so you don't have to. In my experience, people who successfully navigate this are the ones who detach emotions from their money. They stop looking at their portfolio as a scoreboard and start looking at it as a utility. It has one job: to provide power. There is another factor at play, something macroeconomic I have been warning about. For the last 40 years, we have enjoyed an easy period. Interest rates came down steadily. Globalization kept goods cheap. If you bought an index fund and held it, you look like a genius. I believe that era is over. We are entering regime change, structural inflation, the rewiring of global supply chains, the end of free money and zero rates. What does this mean for you? It means the set it and forget it strategy might not work as well in the next decade. You cannot assume the market will do 12% a year endlessly. This is where diversification moves from theory to survival. I have seen too many portfolios concentrated in one thing, all their money in their house or company stock or the US market. Concentration builds wealth, but diversification preserves it. And at this stage, preservation is the mandate. You need to look at asset classes that zig when others zag. But more than asset allocation, you need liability allocation. This is a concept we use institutionally that rarely reaches retail investors. Most focus on assets. I have 500,000. I have 1 million. But what are your liabilities? I don't just mean debt. I mean future consumption, healthcare costs, housing. The smartest households treat their household like a business. They match liabilities. They know basic survival expenses need to be covered by guaranteed income or ultra-safe assets. They don't gamble with grocery money. Then and only then do they take risk with surplus. There is a shift that needs to happen in your brain. You have to learn how to spend. I have observed a tragic phenomenon. I call it the miser's trap. People who spent 40 years saving diligently, they built 2 or 3 million, and when they retired, they couldn't spend it. They had wired their brains to save so tightly that drawing down principal caused physical pain. They lived like paupers, terrified of market crashes. They died with millions having never enjoyed their labor. On the flip side, the lottery winner effect. People who view retirement accounts as windfalls. They buy boats, RVs, second homes in the first 3 years. Then at 75, when health issues start, the money is gone. The middle path requires cognitive shift. You must view savings as a salary replacement mechanism. The goal is to create a paycheck that is sustainable, growing with inflation, and resilient to market shocks. This requires a mathematical plan. I often ask people, what is your number? They say 1 million or 2 million. I say no, that is your asset number. What is your burn rate? If you don't know what it costs to run your life, you cannot know if you are safe. I have seen people with 5 million who are broke because they burn 400,000 a year. I have seen people with 600,000 who are wealthy because they burn 30,000. Wealth is not an absolute number. Wealth is a ratio. The ratio of assets to desires. If you are in your 50s, you have limited ability to increase assets, but infinite ability to control desires and expenses. That is the lever most refuse to pull. There is one final aspect rarely touched: purpose. Why mention this in a financial discussion? Because boredom is expensive. When people retire without purpose, they look for meaning in consumption. They shop, renovate, travel aimlessly. They try to buy the feeling of relevance. This destroys capital faster than crashes. But retirees who are most financially secure retired to something, not from something. They have a project, mentorship, part-time consultancy. They don't spend money filling a void. We are seeing a trend where retirement is no longer a cliff. It is a slope. It is a slope. If you are 60, healthy, with 30 years of professional wisdom, why stop completely? In the knowledge economy, your mind is your asset. Do not look at 65 as the finish line. Look at it as transition to different work. Maybe 3 days a week, maybe consulting. The financial impact of earning 30 or 40,000 a year from 65 to 70 is profound. You don't touch principal for 5 more years. Your investments have 5 more years to compound. That simple shift can double portfolio sustainability. We have covered the landscape, the broken pension system, longevity, risk, danger of inflation, psychology of spending. But understanding the problem is half the battle. The question is, what do you do? How do you structure a portfolio for this regime? At this stage of my career, I no longer think about wealth as a scoreboard. I think about it as a system of responsibility. Capital is not a tool for speculation. It is a tool for stability, progress, continuity. The greatest misunderstanding is that wealth is about accumulation. What matters is what wealth allows you to protect, endure, and sustain. Security, independence, dignity, optionality. These are long-term outcomes. I want you to audit your life, not just your portfolio. Look at spending. Look at purpose. Look at your plan. Ask yourself, am I building a retirement that can sustain me for 30 years? If the answer is unclear, you have work to do. But you still have time. That is the gift of being in your 50s or 60s. You still have time. Use it wisely.